I'd like to welcome everyone to the Big Beautiful Bill podcast. There's been a lot of conversation about this, a lot of questions about this all through the industry. So today, what we're going to do is kind of look at it from a high level, look at what the bill is, some of the high points, and then drill that down to really what matters to our investors or just real estate investors in general. Kind of a takeaway of what they need to know. Before we kick it off, obviously, want to introduce everyone we have here. We have Bill Comeau, who is our Chief Financial Officer. And we also have Naya Pearlman and Ron Kaplan with CohnReznick, all of our subject matter experts that we've assembled for the discussion today. Real quick, want to get a quick disclaimer out of the way so everyone understands the premise for our discussion today. So we'll get right into it. Any advice contained in this communication is not intended as a thorough, in-depth analysis of specific issues, nor is it sufficient to avoid tax-related penalties. This has been prepared for information purposes and general guidance only and does not constitute legal or professional advice. You should not act upon the information contained in this content without obtaining specific professional advice specific to, among other things, your individual facts, circumstances, and jurisdiction. No representation or warranty, express or implied, is made as to the accuracy or completeness of the information contained in this content, and CohnReznick, its partners, employees, and agents accept no liability and disclaim all responsibility for the consequences of you or anyone else acting or refraining to act in reliance on the information contained in this publication or any decision based on it. So we've got that out of the way. And I say we started off with Naya and Ron. Again from CohnReznick, and kind of give us that big, high-level overview of what is this big, beautiful bill.
Well, thank you, Ren. So at a very high level, the One Big Beautiful Bill preserves the marginal tax rates for ordinary income and capital gains. It also extends many of the tax provisions from the Tax Cuts and Jobs Act, but it does modify others. For example, the 20% deduction of qualified business income is permanently extended under the new law. And as a recap, the 199A deduction provides pass-through owners like LLC members a deduction potentially up to 20% of their rental income, subject to certain limitations and restrictions. And the 199 also benefits REIT investors because they can deduct potentially up to 20% of their REIT dividend income. Another provision that benefits potentially commercial real estate operators is the 179 expensing. The new law increases 179 expense limitation, what was an inflation-adjusted $1 million amount to now $2.5 million, subject to a much higher phase-out. And this can help commercial real estate operating entities deduct the full costs of tangible personal property, as well as certain qualified real property. And similar to the bonus depreciation, which I know we're going to discuss in detail further later, the acceleration of these write-offs can be a huge tax benefit to businesses and their owners. Just to point out, though, there are many nuances to 179 expensing rule, so always important to check with your personal tax advisor if the election makes sense for your specific circumstances.
Ron, anything to add there?
Yeah, sure. I would just add that in general, Naya and I both work in our commercial real estate space. That's generally all of our clients that Naya and I represent are in commercial real estate. And for the most part, most of the real estate owners and developers are pretty happy with the new act. It's really I can't think of anything that works against real estate owners, and many items are favorable for real estate owners and investors. I know we're going to get into the biggest one, the bonus depreciation, shortly, but our clients have been anxiously waiting for this, and then I think it came out on around July 5th, and everybody was relieved. July 4th,
Independence Day.
Everybody was relieved that everything went kind of as expected or as hoped for.
Yeah, I know this has been a big topic of conversation both internally, and it sounds at face value that there's a lot of meat on the bone here. There's some potential for some benefits for operators and investors. I know Bill has put a tremendous amount of time into this, But let's kind of take that down the next level. Now we kind of know what it is. There's a lot of technical jargon in there, but what does this mean to a real estate operator or a real estate investor? And I think, Bill, you're ideally suited to kind of bring us up to speed and
Sure.
give a real world example of what that
Sure.
is.
Thanks, Ben. I'll bring that up in a couple. That's what I was looking before to make sure I had that up and ready to go. When an investor or a series of investors, a limited partnership or a fund buys a building, they're actually buying different components of that building. It's not a 39.5 year average amortization of a building. There are components of electrical systems, HVAC systems, even the dumpster and the fence in the back, are all different components of building. And those components have different depreciable lives. We've always at FNRP undertaken a cost segregation study. We engage a professional engineering firm. They actually go out and visit the property, they take pictures, they create a huge report. We hand that report over to CohnReznick, who uses it as the premise for creating depreciation schedules. Where the bonuses came in was back in 2020, I believe, was for the first year we had bonus depreciation of 100%. That's been phased out each year by 20%. And this year we were down now to 40% before the new Big Beautiful Bill came into law. The Big Beautiful Law brought the depreciation back, the bonus, which I'll get into, to 100%. And I think, guys, CohnReznick, that I know it's not phased out. I'm not sure what the life is, but it's a material long period of time. Is it
Permanently. It's
permanent?
permanent.
Okay, great.
Yes.
So I know my head was like nothing to worry about. It wasn't being phased out like the earlier bill. So what that means is basically anything with a depreciable life of 20 years or less, that's a tangible asset, that's not just a loan cost or something, you would amortize that hard asset over 1 year. You'd expense the full amount. And I'm going to show everyone an example real quick of what that means.
And while you
And
bring
I
it
would
up,
say it is important that you consult with your tax advisor. Everyone, our investors consult, because each individual has tailored circumstances that are important that they understand. But this is a real basic example, kind of real life, of a building that we would buy a property for $10 million. Let's assume the land is worth 20%. That's pretty standard, usually between 20 and 25% of the value of any purchase is land, and land's not depreciable. So now you've got $8 million you can depreciate. Well, if you break out the components, that again, hypothetical, we would say, well, maybe there's 5-year assets of 500,000, 15-year assets with a 15-year life of $1 million, and the balance is the bricks and mortar of the building. If you look at how we would typically purchase a property, we would have the building. There's other costs, there's loan costs, there's upfront fees, et cetera, that go into the building. So I just hypothetically put 25% of that in and said, well, if I leverage the building at 60%, I would have about $6.5 million of equity. If we had used no bonus at all, just kind of depreciate everything over their straight lives, the entire fund or partnership would have $331,000 in their first year. The current law has 40%, and that will be phased down, or was to be phased down to 20% of the current law before the new bill. Now at 100%, we're able to deduct the full, anything under 20 years, so the full 500,000 and the $1 million. And what that means is an example. This is not a tax rate. This is just looking at the deduction that investors would get on a K1 if they're able to use it as a percentage of their capital of $6.5 million, goes from 5.1%, the vanilla version of doing this, up to 25%. So hypothetically, you would get a deduction on your K1 just in depreciation of 25% of your contributed equity. Again, we'll say it a lot because there are so many different circumstances. For individual investors, you need to really consult your tax advisor to make sure that this is applicable to you. But like anything else, the more knowledge our investors have, the more they can go back to their tax advisor and say, hey, is this a good thing? And this isn't just for FNRP. This is for any investment you'd make. It's after January 25th. That's of this year. It was retroactively put back. I'm not sure why it went back to January 25th specifically, but that is the date. So anything going forward. Another great thing is it's not prorated. So any investment we buy today, or even technically on December 31st of this year, you would get the full 100% bonus depreciation if you're eligible.
In those examples too, and we talked about it without really calling out the name, but it's cost segregation study.
I'm sorry. Yes, this is the result of thanks, Ben. This is the result of the report that we engaged a consultant, and it's minimal. We spend about maybe $12,000 to $15,000 to engage the engineer. That includes all their costs to go out. They interview our property manager. The property manager makes available to them the roofs, the vacant spaces, the back of the house we call with a lot of the components of the properties in it. Everything is seen. The report is pretty large. It's about over 100 pages, usually of pictures and engineering reports, and a schedule for the accountants. And our accountants, Ron and Naya, keep us really honest. They'll come back and they'll question a lot of times, hey, is the land value right? And these are all supported numbers, but it's good that we have the quality control to make sure we get this right.
Okay.
Just
So, I
one
mean, essentially in a
nuance.
nutshell, for people that are new. Oh, I'm sorry. Go ahead, Naya.
There's just one nuance about the place in service date for bonus depreciation in 2025. Anything from January 1st to the 19th is still 40%, and then it's after the
19th.
19th because
I'm sorry, I had the date wrong. 25th, I thought. But
20th.
regardless, once we're past
Yeah.
that date, anything now going forward
Right.
is covered under the bonus.
See, and that's why we have the
Inauguration date.
professionals.
It's been
That's why we work with professionals, because those are the
Exactly.
ones that
Thank you.
mind those dates. But
We
yeah, the
didn't
cost
buy anything in
segregation.
that month of January, so we're okay there. I put that in mind.
Yeah, so the cost segregation study, just in layman's terms, that effectively, if you look at the building and all its components together, that's just one depreciation schedule. But if you break it down, that exploded view, and break it down to its individual components, there's some opportunity there to accelerate and take some, faster depreciation. Is that
And-
kind of it in a
Yes,
nutshell?
and we never do this on our own. We engage a professional, go out and look at the building. And we used a firm that's a national firm. We've been very happy with their turnaround time is quick. They also provide us with estimates up front. We are able to give those out to any potential investors. It is clearly marked as an estimate. It's a good faith estimate based on the purchase price, the zip code of the property, who the tenants are. But the final report comes out after the site visit is done, and they compile everything, and that's what we send out to CohnReznick.
Great. Well, that's a fantastic recap, and now we kind of understand what some potential tangible, benefits are from the bill. Now, we all know the IRS really doesn't give anything away for free. So I'm thinking there's some other component to this that we probably need to touch on, that, hey, this is not just free money for the IRS. What's the flip side or contrary to this?
Excellent point. So there is a piper to be paid at the end of the day. When you go to sell the asset, regardless of whether you took accelerated depreciation or just regular depreciation, like an example I showed you, whatever depreciation you've taken gets recaptured. It's a little complicated because we look at there's a capital gain component that's based on the purchase price and what we originally bought it for and what we sold it for. But in the middle, all that depreciation that was taken gets recaptured. There are strategies. Again, I advise individual investors to talk to tax advisors of rolling it over to a different investment, and that could be either with FNRP or without it, outside of FNRP, and we enable that to happen as well. We cooperate with that. But there is a recapture. The thing is, there's a time element of money.
Yeah.
Our properties are designed to be 5 to 7 year holds. So if you told me I'm going to give you this accelerated depreciation this year, you have the time value of that money for the next 5 to 7 years. That's a pretty good deal. Now, you don't know where tax rates are going to be. They've been pretty, I haven't seen them go up. It's very unpalatable for them to go up. So you have to assume tax rates would maybe hold where they are. And if you use that assumption to kind of figure out what your investment is and what the time value of that money is, it could be pretty accretive.
Well, and that's
Yeah,
really what
I
we're
would
saying.
just add that when you think about making an investment in real estate and the concept of being able to deduct so much of your upfront cost, it's almost contrary to what you would typically think. So this is a real nice opportunity for investors, assuming that they have an investment they want to make, and the manager is going to embark on a cost seg study and then take advantage of bonus depreciation. It could be really beneficial. But as everyone has said on today's call, it's important for you to consult with your own tax advisor, because everyone's tax situation is different.
Well, and that
to
brings up a
Ron's
good
point, we've seen investors that have had other pretty successful deals that are depreciation waning, and they've maybe held it for 10, 15 years, and those properties are throwing off a lot of taxable income now. You can, in most situations, combine all your real estate holdings, so you can offset your losses, which would be created here through accelerated depreciation, especially in year one, against other investments. Again, it's very situational, but it's a strategy a lot of investors employ.
Well, it seems to me that's one thing that's going to be common here. Of our relationship with CohnReznick as our partner for accounting, it's that same relationship with individual investors and their accountant. you've got to work with professionals to extract the maximum value, to see the benefit, potentially on an individualized basis, or maybe no benefit. But just as it's important for us to work with professionals to get the maximum benefit, individual investors got to walk in with his K1, have that conversation with his CPA, and find out how it works for him. There's no difference.
We've had a lot of investor accountants call us, and they may just not even with a question, just coordination, and we're more than willing to help in that regard. If we need to get CohnReznick involved, we've done that many times to make sure we're getting an accurate answer.
Well, I mean, we've covered a lot of ground here. Obviously, we tried to be time efficient and give the most information in the shortest amount of time. You're absolutely welcome to reach out to the team at First National Realty Partners for some additional information. We'll have the phone number on the screen. To really sum up, it sounds like there was some interesting things in the bill, potentially some opportunities for some investors, again, on an individualized basis. Everyone's going to be different, but maybe the best takeaway from this is now investors can kind of check the box and say, hey, at least I've done my diligence. I've educated myself. I know, as an overview, some of the things that are in the bill, and maybe I can, if nothing more, check off that box that, hey, I can sleep at night now, knowing I've done a little homework. I understand, what it is, and nothing's going to potentially sneak up and bite me. So before we close out, maybe go around the room for some party comments, and we'll wrap things up. And Ron, why don't we kick it off with you?
Sure. I would just say that the bill is very productive and helpful for I think most taxpayers, whether you're in real estate or not, but certainly in real estate. And there's a lot out there, and you should just make sure that you are consulting with your own tax professional. Make sure that you're fitting in the new law with any new laws with your personal tax situation to your best advantage.
Thank you. Naya?
Bill touched a little bit on rolling over gains, and also mentioned that there's going to be another round of OZ designations and opportunities. So investors will once again have an opportunity to defer their capital gains into investing into a qualified opportunity fund, and potentially be eligible for a step up in basis and another, exclusion of capital gains tax if they've held it for the requisite period. But these rules can get very complicated. So once again, always very important to consult with a qualified professional before, you take any action.
Yeah, and it really, we've touched on just, basic components of this. The bill encompasses a lot more, so there's an opportunity for future discussion and future podcast episodes to pass that along. But I think we covered it well. Thank you, Naya. Bill, parting thoughts.
This is a most welcome development. It's probably, as CFO of a real estate company, the thing I'm most happy about in the bill. I think this is going to provide a lot of investors with additional benefits and above and beyond what they already had, and we're excited to have that and offer that to our investors.
Great. Thank you, everyone. Thank you for joining us, and
thanks, Ron and Naya. We really appreciate the partnership and everything you guys do for us, and
thank you.
Look forward to working with you. Continue.
Partners matter. Thank you all for attending, and we'll see you in the next episode.
Have a good day.
Thank you.
Take care.